Well, welcome to part 3 of the Affordable Care Act in pictures. We've had so much fun in the first 2 parts that I had to toss aside the blazer, and we're going to roll up our sleeves a little bit and get into the real nitty-gritty. Right now, we're going to talk not just about the healthcare system, not just about the Affordable Care Act's regulation of the individual marketplace, but about lawsuits challenging the Affordable Care Act's regulation of the individual marketplace. So we are getting really into the nitty-gritty. As we discussed, risk pools in insurance are kind of like cells in biology. The risk pool can exclude some things and let some things in. And when it comes to risk pools in insurance, and you have one on the picture, the risk pool really needs a balance between healthy people coming into the pool and sick people coming into pool. And that's for the simple reason that the risk pool needs enough people who are healthy and paying premiums. It needs enough revenue from premiums every month to pay for the cost of claims it incurs that month from the sick people. And as we discussed last time, the Affordable Care Act prohibits discrimination against people with pre-existing conditions. That's good because it means that somebody who has been sick or is sick is not excluded from buying health insurance, certainly good from their perspective. And the Affordable Care Act nonetheless manages or aspires to a balanced risk pool, even though it creates a rule where someone who's sick can buy insurance by using 2 carrots and a stick. So, you've got the problem that if someone can wait until they are sick to buy health insurance, then they won't buy it. And how do you overcome that if you're not prohibiting people who are sick from buying health insurance? And the Affordable Care Act's answer, was recall, was 2 carrots, subsidies that help with premiums and that help with cost sharing if you buy health insurance. 2 subsidies to encourage people to get into the pool, and also a stick, the individual mandate penalty that imposes a sanction, a financial sanction. You have to pay higher taxes for anybody who does not buy health insurance. And that way it's maintaining an open risk pool, but still creating balance in the risk pool. And you have heard over the years, it seems like every other year, there's another lawsuit challenging the Affordable Care Act. And what did they do? Those lawsuits have gone after the carrots and the stick that make the ACA work. So the first big lawsuit was NFIB v. Sebelius. And that went right after the stick, the penalty for not buying health insurance, the increased taxes you have to pay. And that lawsuit said that that was unconstitutional, that the federal government can't do that. And that was not really successful. If we were talking about Medicaid, that would be something else. Medicaid, very important, but not our topic today. We're talking about the individual mandate. On that, NFIB v. Sebelius, the Supreme Court said, well, the federal government could not force you to buy health insurance. It could not throw you in prison for not buying health insurance, and it could not point a gun at you and force you to buy health insurance. It could not force you to buy health insurance, but it can tax you more if you don't buy health insurance. Just like the federal government cannot force you to buy a kid. You have kids, you don't buy them. The federal government cannot force you to have a kid, but it taxes you less if you have a kid. It can incentivize things through the tax code. And the Supreme Court said, so too with purchasing health insurance. So the individual mandate stick, that penalty survives because the Supreme Court said that is a tax. It increases your taxes if you fail to buy health insurance. So that was challenge 1. Challenge 2 was King v. Burwell. That went after one of the carrots, the premium tax credit carrot, the PTC carrot I have there on the screen. And King v. Burwell was highly technical. It wasn't constitutional. It was statutory interpretation. The argument was that the way the ACA was written, the premium tax credit carrot didn't really work. And the Supreme Court rejected that statutory interpretation argument. The Supreme Court upheld the carrot. It said, no, carrot works fine. The statute permits expenditures on premium tax credits. So challenge 1 to the stick, failed. Challenge 2 to that carrot, failed. Challenge 3 was House v. Burwell. This is a very complicated series of cases and legislative actions related to the other carrot, the CSR carrot, which is for cost sharing reductions. Premium tax credit carrot helps people pay their insurance every month. Cost sharing reductions carrot helps people afford the costs of their deductibles and their copays when they do get sick. And ultimately, I have on the slide that those challenges were successful. The cost sharing reduction carrot was taken out of commission. It's more complicated than that. I encourage you to dig into that case, to other cases, to try to understand it if you're curious. But basically, I would say that that subsidy was hobbled, but it has continued to operate, in particular for some people who enroll in plans. They still get lower deductibles. So kind of a mixed bag. And then not a lawsuit, but probably the most, certainly momentous, not the most momentous, but it is momentous. I'm not going to abandon this video because we're okay with gaffes. That's totally fine. Statute is very important, and that is the Tax Cuts and Jobs Act of 2019. And that came in and went after the individual mandate penalty, that stick again, that increases people's taxes who fail to purchase insurance. And what that law did is it changed the amount your taxes increase if you don't buy insurance to zero. It zeroed out the penalty. So if you don't buy health insurance, the penalty is zero. That's the increase in your taxes. It zeroed it out. So that pretty successfully took out that stick. And if you kind of sum all this up and sit back, the Affordable Care Act's design was kind of built around, we've got these two carrots, premium tax credit subsidy, cost sharing reduction subsidy that you get if you enroll. And we've got a stick if you don't enroll, the individual mandate penalty. And the goal is that's going to lead to balance in the risk pool, even though we're not allowed to change prices or discriminate against those who have pre-existing conditions. So what does that all mean? You know, we've gotten rid of the stick. We've got one of the carrots is kind of hobbled. So does the whole thing fall apart? No, the answer is no, the whole thing does not fall apart, because that other carrot is a magic growing carrot. The PTC carrot, I've drawn it big on the screen. The PTC carrot, the premium tax credit that helps people afford insurance in the individual market, is still intact, and it is built in a way that is very resilient. The amount of the premium tax credit that you receive if you enroll and are eligible is not based only on your income. It is based on your income and the cost of premiums. And specifically, it's the premium tax credit premium is enough money for you to be able to afford insurance no matter what premiums cost. So what the formula does is it calculates how much a given person can afford, what they can pay under the statute. And then the premium tax credit is equal to the difference between what a person can afford and the cost of premiums. So let's say premiums cost $500 a month and the formula says you can afford $200 a month. Well, your premium tax credit is $300. What if we get rid of the individual mandate penalty, cost sharing reductions are very uncertain, there's a lot of disruption in the marketplace, and premiums go up from $500 a month to $1,000 a month? Well, the formula still says you can only afford $200 a month. So all of that disruption, all of that uncertainty, what it ultimately does is it increases what the federal government spends on your premium. On the hypothetical I just did, you know, it would go from the federal government's share being $300 to the federal government's share being $800. That's why I call it a magic growing carrot. The premium tax credit increases as premiums increase in the marketplace, which means that the affordability of insurance in the marketplace for anybody receiving the credit stays pretty much the same regardless of the turmoil and controversy and disruption elsewhere in the statute. Step back for a second. That's all well and good if you receive the premium tax credit subsidy. But to receive the premium tax credit subsidy, you have to make 400% of the federal poverty level or below, or that's something like $47,000 or less for an individual, or $97,000 or less for a family of four. So what if you make $100,000 or more for a family of four? Then you don't receive the premium tax credit, and you are not insulated against disruption that increases premiums or anything like that in the marketplace. So that's the kind of status quo we have arrived at as a result of the legal challenges to the Affordable Care Act and the kind of controversy in the area is a marketplace that still functions and is affordable thanks to the magic growing carrot, thanks to the premium tax credit for those who receive the premium tax credit, and then a market that is often unaffordable for people who do not receive the premium tax credit. Not always, but often. And what does that mean going forward? Well, let me just offer a few kind of concluding reflections and some more terms that perhaps you could go look up if you're curious. One thing that continues to go on the Affordable Care Act is there is legislative gridlock, newsflash. And so what we've seen is administrative, what Alison Hoffman calls technocratic tinkering, agencies within their flexibility trying to tweak the Affordable Care Act in different directions. And we will likely continue to see that. Some examples are reinsurance and high-risk pools. Feel free to go Google or look that up if you're curious. I won't go into it now. Grandmothering and grandfathering, which has in a way drawn healthy people out of the risk pools. Short-term limited duration policies, which are a mechanism through which insurers can prevent sick people from purchasing insurance or charge sick people more outside of the market that may draw healthy people out of the market and have been controversial. I encourage you to go again, Google, read up. There's Federal Register notices, there's litigation. You can read about that. My law students will remember that from our exam last semester. Let's see here. There is association health plans, another kind of at the edges tweak. And that's where we are right now. Going forward, one thing we are seeing and will continue to see is there's a provision of the law that lets states change their own individual market. So this picture could be different in every state. Picture how many YouTube videos we would get. And that is 1332 of the Affordable Care Act. We may see states start to utilize that more and more. We've actually seen it increasingly, especially with reinsurance pools. And then big picture, elephant in the room, is there is yet another direct challenge to the Affordable Care Act, the Texas litigation. The Supreme Court will hear a case, likely later this year, in which the entire Affordable Care Act is again being challenged. You know, just a nugget of what's going on in that case is the argument is that when the Congress, a couple of years ago in the Tax Cuts and Jobs Act, zeroed out the individual mandate penalty, the argument is that it thereby rendered the individual mandate, the stick itself, unconstitutional, and thereby Congress would have intended actually to invalidate the whole thing if we did not have the stick. That's the argument. A lot, I would say that many legal scholars and experts have expressed their view that that argument is a non-starter. Ultimately, it will be decided by the courts, and this is not the space for my prediction on that, but perhaps we can talk another time. That may mean the entire Affordable Care Act gets wiped out, or the entire individual marketplace gets wiped out in court, which is the result that the Trump administration has asked for. Or it at least will, well, or it may mean that we get another lawsuit that does not invalidate the Affordable Care Act. If that happens, which will be my concluding focus, so imagine that we just have another 6 months of uncertainty and then the Affordable Care Act is not invalidated. That uncertainty itself is out there discouraging insurers from joining the Affordable Care Act marketplaces, or maybe making people who are thinking about relying on the Affordable Care Act marketplaces nervous about how reliable they are. So that instability itself affects the risk pool and affects the kind of medium in which the risk pool sits. And if this were in class, I would do a show of hands, but the question would be, who is affected by all of that uncertainty? And I would hope your answer would be, well, people who need to get insurance through the Affordable Care Act marketplaces, who are eligible for the premium tax credit, the magic carrot, they're insulated. If there's uncertainty and disruption, but then ultimately everything works out in court, then those people will not pay the higher premiums. But who is really most affected? It's the people who make more than 400% of federal poverty. Maybe the person who's thinking about quitting their job to start a small business or whatever it might be. Those people bear the brunt. They have to pay the full amount of the premiums. And so the uncertainty is most acutely affecting them. And of course, insurers participate of our journey. So let me say thank you very much if you've made it all the way through these three. Feel free again to block me on Twitter at MJBLawrence, so you will never have to see one of these again, or feel free to follow too. And thanks for coming along.